My name is Clint Edgington, and I am the founder of the Nest Opportunity Fund, along with my partner in crime, Mark Fissel. He's not with us today, but we're excited to have you on board. This is the final update and webinar we'll do before the March 31 deadline that finally made it here. I think it started off, early 2020 for those of you that had sales at the end of 2019, and then it got pushed back to July, then it got pushed back to December, and now it's gotten pushed back again. But my guess is it's not going to get pushed back again. But Azra is the expert in this area, so she can kind of walk us through it. Once we kind of get those poll results, we'll kind of walk through them briefly, give you an idea of what we'll focus on today a little bit. But excited to have you all on board and appreciate you spending a little bit of your time with us today. We'll try to be as brief as possible in walking through this stuff, but I'm excited to share it with you. This is a fund we started not because we were looking to get into the asset management business. We kind of have a tax efficient RIA that we focus on. But because my parents and I have kind of always invested in real estate, and we were doing it side by side with one of our operators at the same time we had a capital gain, we started this fund just for ourselves in early 2019. And then we had clients who kind of asked about it and wanted to participate as well. And so we opened it up to those clients in 2019, and then we opened it up to all folks in 2020. So we like the way we've created this fund because that's what we created for ourselves, and we are in the fund as limited partners. So we hope you like our cooking because we cooked it the way we like it. And if you don't, that's okay too. So without further ado,
I'll go ahead and end the polling. Looks like we've got a lot of votes and we can take it from there.
Okay. Danny, whenever you get the polling, just kind of bring it on up. Okay. Current knowledge of opportunity zones. So it looks like we've got folks with just learning and also intermediate. So we'll kind of try to move through everything relatively quickly then, but we'll also have a recording of the webinar available to you folks afterwards, and you can kind of get on and take a look at it at your leisure then. So our fund is focused on residential rehab in the Midwest, and in particular Columbus, Ohio, and Lexington, Kentucky. And we focus on small assets, so below where institutional buyers would buy in the multifamily space. So the pricing is just a little bit better. So we focus on our largest properties, 32 units. And when you start to get up above 50 or 80, you start to have institutional buyers that kind of drive the price up. Our attorneys make us kind of walk through some disclaimers. So quickly today, I'm going to walk through kind of who we are, the team, and all of our partners like Azra. Some basic background on opportunity zones. Azra will take us through, as well as some of the tax deadlines and briefly through the benefits and deadlines. I'll walk through the actual fund, our strategy. Azra can answer questions certainly on our fund from the tax perspective, because she's kind of the lead tax person on our fund. Then we'll talk about how we've actually executed, a little bit about the terms of our fund for those of you interested in investing. And finally, Azra will take us through some advanced planning. And that will really be pertinent to those of you who have, from the estate side, over 5 million in an estate individually, or 10 million with your spouse, as well as she'll walk you through just from business owners who are selling their properties or their businesses, some ways you can structure things, take more advantage of the opposite legislation. And then finally, she'll walk through something that always confuses me, and that's how depreciation can be structured to be included in a capital gain event and deferred into an opportunity zone fund. So we couldn't have done, I could not have created this fund by myself, certainly. We've got a great team here. Our affiliate is kind of our Beacon Hill. We work with Beacon Hill, which is basically us. We're a small shop. And we've got a great team here. And then our outside partners are integral to doing this. Great attorneys at Kegler Brown help us on the legal side, staying on the right side of all the OZ rules. And then GBQ obviously has been very helpful to us, both in the tax and audit. But our people, the boots in the ground, the construction and property managers are really the folks that do the heavy lifting for us day in and day out. So I won't bore you with my bio, but for Azra's been with GBQ, and she's been with Deloitte beforehand, so she has a long experience, and she focuses on the tax side of a lot of industries. And I can't tell you everyone else's experience with Azra, but she's very knowledgeable and she gets the job done. If you're considering setting up a qualified opportunity zone fund, or just have businesses with some tax issues, you should definitely give Azure and GBQ a call. They've been great to work with, and they are both, they've got great expertise, and they're pragmatic, and unlike a lot of CPA shops, they don't just fill out forms, they think ahead. So without further ado, just wanted to go ahead and pass it off. Azure, thanks for working with us today.
Thank you, Clint, and good afternoon, everybody. As Clint said, I'm a tax partner at GBQ, and I specialize mostly in pass-through taxation. That's how I got to really understand the qualified opportunity funds 2 or 3 years ago when they first came out, because a lot of my real estate clients that are structured as pass-throughs started realizing potential benefits of the qualified opportunity funds. And so 2.5 years later, we're still helping clients like Nest Opportunity Fund and others structure tax efficient structures for their qualified opportunity zone developments, and taking opportunity not only from the federal, but also state incentives and tax planning. So I won't spend too much time on the benefits of the opportunity funds. I think that most of you are very familiar with the 3 key benefits. And so the first one being the deferment of the capital gain tax on any capital gains that are reinvested in the opportunity funds, and those gains have to be reinvested within a certain time frame. We'll go over that in a little while. And what type of gains qualify? It's really any gain that's treated as a capital gain. So it could be a short-term, long-term gain, Section 1231 gains that are generated from the sale of depreciable property that's used in trade or business. So think about any real property most commonly used to defer the tax and the sale of that property by reinvesting it into the funds. So that's the first benefit. It's just a deferment until 2026. And then in 2026, the tax on that deferred gain is going to be due. But if you have held your investment in a qualified opportunity fund for 5 years, you're only going to pay the tax on 90% of that deferred gain. In other words, you get a 10% step up in basis after 5 years that is tax-free. And then the final and the biggest benefit that most investors are really interested in is the tax-free growth of that investment. So as long as you stay in the fund for 10 years, upon the exit from the fund or the fund's sale of those assets after 10 years, any appreciation of your investment is going to be tax-free.
And then one thing that I feel like is under spoken about is also for any of you who own or have owned investment real estate, you've always gotten your depreciation loss every year you can write off against your passive income. But then when you sell it, you usually have to pay depreciation recapture. And for the opportunity zone funds, we will not have to pay recapture. So we kind of get our cake and eat it too on that end.
Right. All right, so there are some timelines here that the investors have to be familiar with. The first one would be in a year when the investor realizes capital gain. There has to be, and I'll spend a couple of minutes on this first one because there have been some changes over the last year, as Clint has already indicated. That capital gain has to be reinvested into qualified opportunity fund, generally within 180 days from the gain being realized. If you're an individual taxpayer, you have 180 days. If you are getting that gain as part of, as a partner in a partnership, and the partnership is the entity that realized the gain, the partnership, let's assume the partnership elects not to invest that gain into the fund, then you as a partner really have some more flexibility as to the timing when you have to reinvest your share of the gains. You can start your 180-day reinvestment clock either on the last day of the tax year when the partnership realized the gain, or you can start it on March 15, which would typically be the due date of that partnership tax return. Now with the COVID pandemic, we have had a couple of extensions for that 180-day reinvestment. And why that is important is because the final extension is coming up here on March 31st. And so if you had gains that 180-day period was going to expire between April 1st and the end of 2020, the government gave you basically until March, end of March of this year to reinvest those gains. And so you could potentially have an investor, or you could be a taxpayer that had gains realized in October or November of 2019.
I think it's October 5th is the cutoff date, right?
Yes,
Yeah.
that you could still invest in the next couple of weeks and defer the tax on that gain. Obviously, you probably already paid a tax on it since you filed your 2019 returns, but you could go and amend those returns to get the refund.
And I'll tell everyone, it's been kind of confusing since there's been extensions. There currently are no other extensions set forth right now, and who knows what will happen. But it's what we recommend to folks is we've got the ability. We'll send a customized calculator out to everyone who's on the webinar right now, and we're happy to calculate out, what your actual deadline is. Even if you choose not to invest in our fund, Azra and I can get that together, as well as just kind of we'll run through next, which is, well, we'll run through after this, which is basically the kind of a cost benefit analysis that can help you quantify the benefits or to see if it's worthwhile for you.
Yeah, so this slide really quick. I mean, in addition to the federal incentive, a lot of states conform, most of the states really conform to the federal opportunity zone incentives, as you can see in all these green colors. I would highlight 2 states. California probably would be the most notable one, and in North Carolina, as well as looks like Mississippi. They don't conform to federal qualified opportunity zone incentives. So you could still invest in opportunity fund that develops property, for example, in California. You just wouldn't be able to defer that gain. You wouldn't get any benefits on the state side.
Yeah, so no benefits to the state side. I think Massachusetts is also in there as well. And again, it does kind of decrease the benefits for an op zone investment for you. If you want to just shoot us your information, we can kind of plug it in and actually walk it through. I mean, California, for example, has a pretty high state income tax rate, which would govern this, like at 13.3% at the top end.
Right.
So it does impact it. And you should also, if you choose to invest in a state that is not conforming, if you choose to invest in a qualified opportunity zone fund that invests in a state that is not conforming, you're going to have some sales tax on the back end of your investment as well. You should probably be aware of.
All right, so let's run the math here, and Clint, you can help me if I mess up here. So basically what we wanted to show you a comparison between 2 different investments. And let's just assume in this hypothetical example, you have a taxpayer with $1 million of capital gain, and he or she has a choice to invest that gain into qualified opportunity fund or just go the regular investment route and invest it in a non-QOF. And so if it's a non-QOF investment, they would take that $1 million capital gain and they would have to pay a tax on it using the capital gain tax rates. Here we used 20% federal, 5% states, and then 3.8% net investment income tax. So there would be a tax due there on day one of $288,000. So the investor would really be left with only $712,000 to put that money into the new investment. That would then grow at 6% appreciation per year for 10 years. Which would mean another $563,000 of additional gain when that property or investment is disposed after 10 years. And so not only they had to pay a tax on $1 million, now on the exit, they had to pay tax on that additional appreciation. So the growth above the original $1 million is only $112,000. Now you compare that to the same $1 million gain that's used to reinvest into opportunity fund. So the first thing you can see here that's different is there is no tax on day one. You can invest that entire $1 million on day one before any tax and let that entire amount grow at 6% until 2026. Then in 26, you have to be able to come up with cash flow to pay the tax on that deferred gain. But remember, you're only paying tax on $900,000, not the entire million, because you're getting a step up. So that tax would be $259,000. And then your appreciation on the investment would be $790,000. When you exit it from the fund in 10 years, you're not going to pay tax on any of that appreciation. And so that really significantly increases the rate of the return, assuming all other items equal with the appreciation and tax rates not changing. And so you can compare that growth of 531,000 compared to only 112.
Yeah. So again, we've got a calculator that we're happy to run for people, even if our fund is not the right option for them. And some folks want to have a different rate of return and the two kind of options, and we're happy to kind of run that and plug it in. So I'm just going to run through kind of our fund, kind of what we're looking to do and how we have it structured. So if you're interested in a conservative fund, both kind of on the risk and the expected return, we're a good option for you. We're kind of smaller, family-oriented feel, and if that appeals to you, that's great. We'd love to have you as a partner. And if it doesn't, that's okay too. So our space, again, with pretty much everything we're going to do, it's going to be relatively conservative. So we're in the most conservative section of real estate that you can really be involved in this, in the residential area in particular. Generally we think in where you can invest, we think of multifamily, but really that's where institutional money can move around with. There's not a lot of options for single family, but single family is kind of the safest. I can close my eyes in 10 years and know folks are going to want to live in houses and apartments. It's a little more difficult especially with COVID this year, to think through like, what's hospitality going to look like? What's office going to look like in 10 years? So I'm not that imaginative of a person. So we stick with what we know and what we've done for quite a while. And that's that kind of conservative asset class of single family and multifamilies. You should know for all the OZ funds that you're kind of thinking about, on the strategy side, we all have a relatively risky strategy. So, with real estate, you could buy and hold an apartment building that's already completely rehabbed, good tenants in it. And then that's great. And that's going to give you a pretty low rate of return, but it's not very risky. But with all the OZ funds, we have either what we call a significant improvement test or an original use test. So we have to either be building something or be doing significant rehab to them. And that's a little bit more risky, but it gives you more returns. So all of us are going to kind of have that riskier strategy. So for us, we just decided to kind of balance out the riskier strategy with the more conservative asset class. And it's also what we've done and what we know. On the same page, what we were looking for is areas that we could kind of go to and back to do asset visits and be back in time for dinner, because real estate, as most of you all know, it's a ground game, and a great operator in a terrible area will do okay, and a terrible operator anywhere will not do well. So you've really got to be there and have those boots in the ground. So what we're looking for is, on the conservative side, we want stable workforce, stable employment opportunities for tenants. We want to have demographic tailwinds. So we want a population that's growing. 10 years is a long time. We want that to be something that makes it easier for us over time. And then what we would love is supply constraints, which are tough in the Midwest. But the Midwest generally has it doesn't have as volatile of housing prices on the coast. So the two places we're in, Kentucky, Lexington, Kentucky, and Columbus, Ohio. Columbus is a capital city, so there's a good government workforce here. Even our finance, which you usually typically think of as being relatively kind of volatile workforce, for us, it's pretty much insurance. We've got great insurance laws here. So Nationwide is located here, quite a few others. Lexington is a smaller version of Columbus. It's not a capital town, but it's got heavy government workforce, as well as it's a university town like Columbus. University of Kentucky is there, so that also has a good stable employment base. When we look at the demographic trends, we kind of were looking at where in the Midwest is growing. And what we can see for both of our areas, it's in kind of the top 4 high growth areas. If you're not from the Midwest, you kind of draw a line from Chicago to Cleveland to Pittsburgh. I generally think of things above that are a little bit Rust Belt with some demographic issues. So we're going to go a little bit south. So Indy, Louisville are also good options. We just don't have operators there. We don't have a footprint there, but we may someday. Within Columbus and Lexington, we can actually see that the areas outside of the metro area are growing very rapidly. And they're growing very rapidly because our inner cores are essentially kind of built up. And we've got some zoning issues where we have some zoning issues in Columbus where, the sprawl of the suburbs is difficult for the affordable space. Lexington, we'll talk about a little bit. Probably people who are a little less familiar with Lexington. We have a great relationship with the city, and they like some of our social impact programs we put forward. And they've actually given us some grant money that will help and it directly inures to our partners. We can just kind of buy more property with that. But within Lexington, the supply constraint there is very unique for the Midwest. Essentially, it's just due to the horse farms there. So if you've watched the Kentucky Derby, you kind of see the pastoral setting above it. And if you've driven from Louisville to Lexington, it's a beautiful drive, you know that. And if you haven't, you should. But they really wanted to protect that setting of the pastoral horse scenes. And so they put in place in the 50s the nation's first urban growth boundary. And effectively, outside of the area that you see in yellow, you really can't subdivide lots more than 20 acres per lot. So we've got a really nice tight supply constraint. They vote to extend that out every 5 years. And in 2018 was the last vote. And they voted to extend it. And also they voted not to take the vote in 2023. So effectively for at least 8 years of the time that we'll be there, there's going to continue to be that supply constraint. Columbus's supply constraint is much looser. It's not kind of a bright line, and it's less of a supply constraint, but the land use approvals are an issue for higher density development. So you can have single families with a decent sized yard, but it's difficult for them to put many bodies in it. And Columbus is growing pretty fast. It's kind of the largest town that most people aren't really that familiar with. We've got about 3 million in the MSA, although that overstates it a little bit. Columbus's MSA just gets kind of huge. Also within Lexington, outside of this green area that's not even on the map, about 80% of the areas that go out about another 10 miles, the owners of the property have donated the development rights of their land essentially to lock it up so their kids can't put in developments. So when we zoom into Lexington, here's where our properties are. And the blue is basically where the opportunity zone is. We've been working with our partner down there for 8 years or so before we called it an opportunity zone. And, we like the areas we're in. If you're familiar with Lexington, we're in the No-Lie district quite a bit. And there's a lot of changes going on down there, and particularly going on kind of around our properties. But you can still pick these, as long as you're going kind of for the vacant properties that are the worst house on the street, we can still pick these up pretty cheaply. And there's going to be a lot of changes that are going on. And we're seeing it already just around our houses. There's coffee shops going in and whatnot. But the city's putting a ton of money into basically redeveloping Rupp Arena. They're going to basically expand the convention center size from 70,000 square foot to 800,000. It's going to be a very cool bike park they're starting to work on that kind of cuts through town, goes along what now is a little culvert of a creek, but they're going to kind of open that up and make it a bike path. And it's beautifully kind of dumping out into where our properties are. There's also a CDFI that's putting in an artist village with little glass garage doors. And they're going to have art shows there, and our properties are right on that block. So we're in a good place. We like it. Columbus is much bigger, as you guys probably all know. Some of the areas that we're in, a lot of these areas are kind of going to be up and coming and not there yet. But the trends are kind of set in place, especially for Franklinton and Columbus, that the major developers already own a good chunk of it. And although right now a lot of those lots are vacant, they have plans to put in place some pretty interesting stuff. So that area for sure is going to change. Just walking through, how we've done with what we've worked so far. We've kind of got the machine and had it up and running for a while now. We started back in January 2019, just us, just kind of the partners and our operator. We threw about $500,000 in. We also lent a little bit in as well. But we threw kind of all of our capital gains at that time in. And we purchased 23 units. I think that was about 21 properties. So a lot of single families. And you can see the majority of them, when I can think of stages that we have as far as rehab goes, initial rehab is when we're kind of starting the demo. Final rehab is when it's drywall's up. We had only one property completed with, I think, 2 units. And then when we look where we're at today, we've got 82 units. And the majority of those that are still in rehab are just about to kind of complete rehab in the next few months. So we've got the majority of those in that final rehab stage. And we always want to keep a little bit of inventory. A house is sitting there waiting. One of the difficult parts of this business is maintaining and keeping good crews that are kind of trained on our systems. And we can do that much easier by being able to say, hey, listen, after you're done with this project, you go to the next project and it's right there. And that really helps it so they're not kind of out looking for other work. And we want them to be as ingrained in our fund as you can. Of the properties we've have completed, we have 12 units completed. And I think that's about 10 properties or 9 maybe. And we have had 8 of those appraised. And we've got the appraised values are 23% above our all-in cost on those properties. So I don't know what the real estate market is going to do in 10 years. But it just tells us that our rehabs are adding value. And that 23% is kind of well above our projections. I assume it'll probably go down at some point in time. But so far we're running ahead of where we thought we would be. So just kind of looking at a regular, just one individual project. This is a smaller project, just to give you an idea of how an individual project might look. When we go to purchase a property, we kind of do an internal underwriting process. And what we're looking for is we want to have 15% annual rate of return when we're kind of doing our projections. And we also want it to cash flow with 70% leverage, which is a little higher than we're going to have the leverage of the fund at, but we want to have that ability to cash flow. There might be another reason why we purchase a property that doesn't fulfill one of those 2 criteria. So for example, we owned 3 vacant properties that we were about to move to for construction, and another vacant property came up. Nobody else knew that those other 3 properties were going to become the nicest properties on the street. So we could kind of buy them at a depressed price, knowing that it's going to turn around. So that's an example. I'll also say that this particular item has a better, what we think is the rate of return now is better than what our average project is going to be. So it's a little optimistic, but it just was a very standard project. So for this project, you can see it's 456 Chestnut. The bottom left, our purchase price is about 40 grand. So we can still pick these properties up pretty cheap. Our rehab cost, we thought would be about another $40,000, $50,000. And, we assumed a pretty small value coming out of it. In actuality, our rehab costs were higher. Lumber prices have tripled in the last year, so that's been fun. But our coming out appraisal value is higher too. Looking at operating cash flows, especially for our single families, what you'll see is that they don't yield an awful lot of money. So if you own single family rentals, you really know, like, you make your money when you sell them because you've got that build up equity. So our gross rents would be about 11 grand a year. And then our kind of operating expenses are about 8 grand, plus we have about $2,000 in debt pay down per year. So feel free to ask any questions as we go if you have any. We'll open it up at the end, or you can feel free to reach out to me directly. So the one thing I do want to walk through is we've closed down our A series. So it's all the same fund. If you want to invest in the Nest Opportunity Fund, it's the same fund as what everyone else has invested in before. And we just put a little seed investment in as well. But we've now opened up the Series B. And that's effectively so folks who invested in the Series A back in December of 2019, they don't have to wait for your 10 years to be up if we would decide to sell that whole entity to maybe a single family REIT or whatever it would be. So all the properties we have now are Series A, but we'll be doing the same thing with the Series B. So same strategy, same operators, same boots in the ground. Just some financial terms to walk you through. I won't be too awful long with this. We'll pass this out for folks at the end. But we do communicate with our LPs on a quarterly basis. We send a letter. We also have these webinars, as well as I know we have a few investors on the line that anytime you want to call me, if you're an investor, we give our cell phone to you, and you can give us a call and have questions and interact with your CPA. As far as leverage goes, we target a 65% leverage. We're not there yet. We still have a good chunk of cash, and we like to have a nice cash position. But as we continue rehabbing, we'll have that target leverage of 65%, which for a lot of commercial real estate is kind of normal, or even for hospitality, riskier things, it might be on the high end. For single families and multifamily, it's pretty conservative leverage. And again, what we're trying to do is we want the highest probability to get good capital gains in 10 years. We're just looking to hit singles and doubles. We're not looking for home runs and their attendant strikeouts. Our projected IRR rate of return is about 10%, not including the option benefit. The option benefit is kind of weird to calculate since you're including tax from a previous investment and this investment. But when we include those, there's a few ways to do it. We chose the most conservative method. It adds about another 2%, and the other methods would add 4% on per year. We're running above our IRRs right now. We might update that at some point, but for now, we're going to stick with our conservative assumptions. Our minimum investment is 200 grand. If you don't hit that 200 grand, but you will in the future, or you think you would in the future, and we can kind of have an agreement where as long as we do what we say we're going to do, that you'll invest more in the fund when and if cap gains come up. We're flexible with that. Just give me a call. We do have a limit on the number of investors we can have in our fund, though. So we do want to stick somewhat close to that. Walking through, so we've invested 570. The sponsors invested 570 in the fund. Actually, that's now 620 since we just put a little bit more in the B series. Our management fees, we're actually invested as LPs. So while we also own the GP, like the fund that, or the entity that runs the fund, and in return for running the fund gets paid through fees. Our ownership, that 620 grand, also pays the same fees you do, and we'll have the same results. But our management fee is 1.5% per year of net assets. And then you get a preferred distribution of 4% per year. And that's not necessarily every year. We took a vote to our members last year if they wanted the pref or they wanted to keep it reinvested. And they all voted to keep the preferred distribution kind of reinvested. We assume that our partners will continue doing that. However, in 2026, we will pay back any prefs that are in arrears so folks can have money for taxes. Then you get a full return of capital, and then there's a profit split. So you get 85% of profits, and the GP gets 15% of the profits. So the management fee just kind of keeps the lights on, and then kind of the profits are what we all hope to get. Again, we also have a PPM, and I'll walk through that at the end. But you really need to kind of dig into that there. We don't have a lot of nickel and dime fees, but something you should do for all funds you're looking at is kind of dig into the PPM a little bit. Azra, you want to walk us through some of the, do you want me to take a state, or do you want to?
Yeah, so as an additional incentive from the estate planning perspective, there are a couple of things here probably worth mentioning. So the estate exemption currently is set at $11 million, a little over $11 million, and it's set to sunset in 2026. Obviously, unless we have further tax reform changes from the current administration that could change before 2026. And so from the Qualified Opportunity Fund perspective, there is a potential benefit here for a person who has a capital gain, basically to reinvest into Opportunity Fund, and then put that fund into a grantor trust. And so they would be able to defer the taxes on day one. And then for the descendants who are going to receive a gift of that fund, they would basically just step into shoes and be able to have a tax-free exit once that fund investment is disposed of in 10 years.
Yeah, we're with our advisory clients. I don't know about you, Azra. We're really starting to try to push that, like, kind of advanced planning if they're getting there where the estates are going to start to affect them, because you have the ability to take advantage of the gift exemption of that 11.5 million now. But once that sunsets, you'll no longer have that ability, and there's not going to be any sort of clawback. So, you know, the beautiful thing about you can marry the GRAT and the Qualified Opportunity Zone Fund, and basically you get the benefits of both and the negatives of neither, where you have the growth that occurs in the GRAT and in the Qualified Opportunity Zone Fund. But usually with the GRAT, the beneficiary has to pay the capital gains tax at the end. It also works really well because just from an investment perspective, as I'm thinking through, your timeline on both of these has to be a very patient timeline.
So a couple other items that pop up occasionally with the potential investors. A lot of investors have what's called Section 1231 gains. So that would be a gain if, let's say, you sold your entire trader business, or if you sold rental property. Generally, that's any asset that's used, depreciable asset that's used in a trader business. And so what people generally think is, originally when these rules first came out, and they have changed 2 or 3 times since, the IRS said, well, on these types of gains, the 1231 gains, you have to net your gains with the losses. And so if you had properties that you sold at gain and you had other properties that you sold at loss, you would have to wait until the end of the year and only eligible to reinvest that net gain. When final regs came out a little over a year ago, they changed that rule favorably, and it's really favorable for the investors, where you can cherry pick only your 1231 gains and invest those entire gains into the fund and defer the tax on it. And then if you have 1231 losses, you don't have any gains to offset them against, and you're able to take those losses in that year as an ordinary deduction. So you're not only deferring the gain on the gains, you're able to benefit from getting ordinary deduction on the lost properties.
So in effect, and we've worked with not many. I want to do this more because I'm interested in this. But we've worked with 1 or 2 business owners who sold, and they had some 1231 assets, and you can effectively convert capital gains. You can convert into capital gains and create income losses. So if you have a Qualified Opportunity Zone Fund that you like Nest Opportunity Fund, or your own QOF, you can kind of create some capital gains that are taxed at a much lower rate and get some income losses which are taxed at a higher rate.
Correct. So, and the other item here on this slide is with respect to real property. A lot of times people think that only the gains on the appreciation from the original cost of that property would be eligible for reinvestment as capital gains. A lot of people think that depreciation that's taken on the property doesn't qualify because it's subject to recapture. With real property, that's really not the case. Real property is treated as Section 1250 property under the Internal Revenue Code. And typically, the entire gain on a real property, including depreciation that's taken on it, is eligible to be reinvested as a qualifying gain. Now, the only caveat here is if you have personal property that is attached to the real property that you have fully depreciated using bonus depreciation or something like that, you may have some ordinary gain when you sell that entire property that would not be eligible. But typically what we see, most of the purchase price allocations generally allocated to real property and land, don't see too much in ordinary gains from personal property.
Yeah, and that is a confusing area for me. I have to kind of read it every time and kind of walk through what would be 1250 versus 1245. The next 2 slides, we just have some information on how to reach out to us and to GBQ. Again, this is our last webinar before the March 31st deadline. So if you have an interest in our fund, reach out to us. We've got tons of resources for you. We can include, we'll send you all our deck, which is a summary of the fund, as well as information about ASRA and GBQ. If you have an interest, basically we kind of have a conversation, find out what your cap gains are, a deadline, what you're looking to do, generally speaking, make sure that there's an alignment. Obviously, one of the drawbacks to any opportunity zone fund is it's a 10-year investment. So we want to make sure that our partners are aware of that, because I don't want to have unhappy folks in 5 years. But we want to make sure that we're kind of on the same page with things. But then what the basic process is that you review the PPM that we'll send to you, private placement memorandum, and you'll sign that PPM. In addition, we're a 506D regulated firm, so we have to verify accreditation. What that means basically is that you need to have a net worth of $1 million or income of 200 grand individually or 300,000 joint. If you're an entity, it's a little bit different. We can walk through that as well. But we get that taken care of. Then we send you wire information, you wire to the fund, and then we send you our new investor packet, and we talk to your CPA so they know how to indicate that you've invested in the Qualified Opportunity Zone Fund, and you don't have to pay the capital gains tax. So reach out to us, even if you choose not to invest in our fund. If there's another fund that maybe makes a little bit more sense for you, or you're not sure if you want to at all, we've got the calculator that I think that you probably should run. The drawbacks to an Opportunity Zone Fund are easy to think about and kind of internalize that liquidity and that 10-year hold. But the benefits are a little bit harder, to think through how it's going to impact you and your personal tax rates. So hit us up with that. We'll shoot that stuff off to you. Some other ways you can kind of look at us and link up. Again, we'll send this stuff off to you. I really appreciate everyone's time. And Azra, thank you so much for your help. I think it was very clear and helpful for me.